Welcome to the deep dive. Today we're digging into the research you sent over, and we're aiming for one clear thing. An actual usable blueprint for getting started in the stock market. Forget the complex jargon, okay? This is about giving you the exact steps. 0 to, well, building something solid. Yeah, for so many people, investing just feels, I don't know, intimidating, like a gamble only experts can play. But the sources we looked at argue the real point isn't just chasing quick wins. It's about building genuine financial freedom, making your money work for you, harder than you do, ideally. That's the goal today.
And it's built on a surprisingly long history. You know, this isn't some flash-in-the-pan digital thing. We're talking roots back in, 13th century Europe, merchants in places like Antwerp trading ownership stakes. Then jump ahead, you get a more formal structure in 1792. The Buttonwood Agreement. It sounds quaint, right? Just 24 brokers under a tree in Manhattan. But that meeting, that basically became the New York Stock Exchange.
And that history, that longevity, it really matters. It lets us see the market not as this fragile thing about to pop, but as an ecosystem that endures. Think about what it's weathered. 1929, the big crash. The dot-com bubble bursting in 2000. 2008, the financial meltdown.
Right. And despite all that turbulence, the long-term data, well, it's overwhelmingly positive. If you look at the S&P 500, that's the benchmark most people track. It's delivered around 10% average annual returns over decades. That's the bedrock.
10% average. That's powerful.
It is. And to put a picture on it, one source calculated that $10,000 invested way back in 1926. Today, it would be worth over $10 million, and that's after adjusting for inflation. So yeah, the resilience pays off.
Okay, absolutely. The long-term picture is compelling, but let's get practical for someone starting now. What are you actually buying when you hit that buy button on an app?
Well, the basic idea is actually pretty straightforward. The stock market. It's just a huge global marketplace. You're buying and selling tiny pieces of ownership shares in public companies. Think Apple, Amazon, companies like that. Exchanges like the NYSE or NASDAQ handle the trading. So when you buy a share, say, of Apple, you literally become a mini owner. A very, very small owner, but an owner nonetheless.
A mini owner, I like that.
And that ownership slice means you have a claim on the company's success, either through dividends, that's cash payouts, or more often with growing companies, the share price going up over time.
What's interesting, though, is how easy the mechanics are now. The apps make buying a stock as simple as ordering food, like you said. But the sources really hammer this point. The tough part isn't the clicking, it's the mental game.
Exactly. You don't need a PhD in finance anymore.
No. But apparently markets are, 80% psychology? Fear and greed often move prices more than the actual company news, especially short term. Managing your own emotions, that seems to be the real challenge.
That's spot on. So knowing that, you need to know what you can actually invest in first. The material breaks it down into 4 main types for beginners. Different levels of risk, really. First up, individual stocks. This is you betting on a single company. Try and find the next big thing, like Tesla or Nvidia maybe. Huge potential upside, sure, but also maximum volatility. It's like strapping yourself to a rocket.
Okay, rocket sounds exciting, but maybe a bit terrifying for a first-timer. What's next?
Right, so the more diversified options. Second, you have ETFs, exchange-traded funds. Think of these like pre-packaged baskets of stocks. Instead of one rocket, you buy a piece of a whole fleet, like the SPY or VOO. They track the entire S&P 500. So you get broad diversification instantly, usually with very light cost.
Diversification in one click. Makes sense.
Then number 3, mutual funds. Similar idea, also baskets of investments, but these are typically actively managed by a fund manager or a team. They might have higher fees, maybe minimum investment amounts, and they usually only trade price once a day, unlike ETFs, which trade like stocks.
Okay, so similar to ETFs, but with a manager actively booking potentially higher costs.
Correct. And fourth, the one that gets a lot of attention, index funds. These can be structured as mutual funds or ETFs, but their whole job is just to passively mirror a specific market index like the S&P 500 or the total U.S. stock market. Minimal costs, very hands-off.
And this is where that Warren Buffett advice comes in, right? He famously recommends simple, low-cost index funds for most people. Says they tend to beat the majority of those actively managed funds over the long haul. That's quite an endorsement for keeping it simple.
It really is. Hard to argue with that track record.
All right, so we know the what. Let's pivot to the how. The actual roadmap to get started. No more theory, just action steps.
Okay, let's lay it out. The first 4 steps are really about building the foundation. Step 1, assess your why and your risk radar. You need to know why you're investing. Is it retirement in 30 or 40 years? Buying a house in 5? That goal helps determine how much risk you can or should take.
And how do you gauge that risk?
Well, imagine your portfolio drops 20% in a month. which happens. If the thought makes you sick and want to sell everything, you probably have a lower risk tolerance. You should lean more conservative. But a key tip from the sources. If you're young, say in your 20s or 30s, time is your biggest advantage. You can afford to ride out the dips. The recommendation is often leaning heavily into stocks, maybe 80%, even 90% when you have decades ahead of you.
80 or 90% stocks.
Yeah.
That sounds intense for someone new. How do they know they can really stomach that kind of drop when it inevitably comes?
Because it will, right?
That's a really important point, and it leads directly into step 2.
Yeah.
Build your war chest. This is non-negotiable. Before you invest a single dollar in the market, you must have an emergency fund. We're talking 3 to 6 months of essential living expenses. And keep it safe, liquid, like in a high-yield savings account. Right now, those are paying maybe 4%, even 5% APY, risk-free return while it sits there.
So safety net first. Always. Always. Then, once that shield is in place, you figure out how much you can consistently invest. It doesn't have to be huge. Start with $50 a month, $100 a month, whatever fits the budget. The key is automating it. Set up automatic transfers so it just happens. And remember that compounding math we talked about. Even $100 a month growing at an average of, say, 7%. Over 40 years, that can turn into like $250,000. It works, but you have to start.
Okay, emergency fund secure, automated contributions set up. What's next? Step 3, pick your battlefield, the brokerage platform.
Right.
You basically have 2 main paths here. DIY do-it-yourself brokers or robo-advisors. DIY platforms like Robinhood or Fidelity give you full control. Robinhood's popular for beginners, lets you buy fractional shares like $5 worth of Amazon. Fidelity has great research tools if you want to dig deeper.
Or there's the other path.
Yeah, the robo-advisors. Companies like Betterment or Wealthfront. You tell them your goals and risk tolerance, and their algorithms build and manage a diversified portfolio for you. It's very hands-off, but they charge a small annual fee, usually around 0.25% of your assets.
And a quick note on the tech side for 2025, a lot of these platforms, especially the DIY ones like Webull, offer free paper trading now. It's like a simulator. You can practice trading with fake money, get comfortable with the platform, test strategies, all without risking any real cash. It's a great learning tool.
Good tip. Okay, platform chosen. Step 4.
Step 4, open the gate. This is about the type of account you use. You can always use a standard taxable brokerage account. It's flexible, but the sources really emphasize using tax-advantaged accounts first, if you can. The big one is a Roth IRA.
Roth IRA. Tax-free growth and withdrawals in retirement.
Exactly. Huge advantage long-term. For 2025, the contribution limit is $7,000 if you're under 50, and maybe even more important.
Let me guess. The 401k match.
You got it. If your employer offers a match on your 401k contributions, say, they match 50 cents for every dollar you put in, up to 6% of your salary, you absolutely have to contribute enough to get the full match. It's literally free money, an instant 50% or 100% return. You won't beat that anywhere else, guaranteed.
Okay, so max out the match, then look at a Roth IRA, then a regular brokerage. Make sense? Now the action steps.
Right, the final 3. Step 5, fund and fire your first shot. Link your bank account, transfer the money you've set aside to invest, and for that very first investment, keep it simple. Buy a broad market index ETF, something like VOO, which tracks the S&P 500.
And you mentioned a strategy for how to invest that money.
Yes, crucial point. This ties into the first shot and every investment after. Dollar cost averaging, or DCA. Don't dump all your money in at once. Instead, invest a fixed amount, say $200 on a regular schedule, every month, every 2 weeks, whatever works. You do this whether the market is soaring or tanking.
Why is that so important?
Because it takes emotion out of the equation. It stops you from trying to guess the market's peaks and valleys, which is basically impossible. When prices are low, your fixed amount buys more shares. When prices are high, it buys fewer. Over time, it averages out your purchase price and smooths out the ride. It's like an emotional circuit breaker.
Okay, DCA. Got it. Step 6.
Step 6. Track without obsessing. Check your portfolio maybe once a quarter. Get a sense of how things are doing. Reconfirm your strategy. But don't check it every day or even every week. That just invites anxiety and impulsive decisions. Remember that saying? Markets climb a wall of worry. Let them climb.
Resist the urge to constantly refresh the app. Easier said than done, probably.
It takes discipline. And finally, step 7. Scale with smarts. Once you've got that core index fund position built up, you can start thinking about adding other pieces, maybe some bonds for stability, using a bond ETF, or international stocks for global diversification, like with an ETF called VXUS. An advanced move could be adding what some call a forever stock, a really stable blue chip company known for paying reliable dividends, like Coca-Cola. It just provides steady income.
Okay, that's a solid 7-step launch plan. Now let's talk strategy beyond just getting started. How do beginners actually navigate the inevitable ups and downs and, stick with it?
Well, the bedrock strategy, the one that underpins everything for long-term success, is buy and hold. Find good quality diversified investments like those index funds we talked about and just commit to holding them for at least 5 years, preferably much, much longer. The data here is just incredibly compelling. Someone looked at the S&P 500 since 1950. Over any rolling 10-year period in that time, it's never lost money, 100% positive returns over a decade. Patience is rewarded.
100%. That's hard to ignore. So buy quality, hold tight, use DCA. That's the core.
That's the unbreakable core, yeah. Once you're comfortable there, you can explore ways to potentially sharpen your edge. Two main schools of thought often come up: value investing and growth investing.
Let's break those down. Value investing first.
Value investing is like treasure hunting. You're looking for companies that the market seems to be underappreciating right now, stocks that look cheap relative to their fundamental worth. You look for things like strong financials, maybe a low price to earnings ratio or a PE.
And PE is just
price to earnings. It's basically a measure of how much you're paying for each dollar of the company's profit. A lower PE might suggest it's undervalued. A potential value play in 2025 based on some analysis, maybe certain energy or utility stocks. They're essential, often overlooked, maybe trading at lower PE ratios. And crucially, they're needed to power this whole AI revolution everyone's talking about. That creates underlying demand.
interesting angle. Okay, so that's value. What about the other side, growth investing?
Growth investing is almost the opposite mindset. You're looking for companies with massive potential, the disruptors, the innovators. These companies are often reinvesting every penny back into growing the business, so they might not have much product now. Their PE ratios can be sky high. Investors are betting heavily on future earnings growth. Think about NVIDIA recently with the AI chip boom. Huge growth, huge stock appreciation in 2024. That's a classic growth story.
Got it. High potential, often higher PE, betting on the future.
Exactly. But with any strategy, we absolutely have to talk about the dark side. The risks, the mental traps. First, volatility is just part of the deal. Prices will swing, sometimes wildly. And yeah, the forecast for 2025 suggests maybe more choppiness with election cycles, inflation questions.
So expect bumps.
Expect bumps. But the real enemy, it's usually staring back at you in the mirror. It's psychology. We're wired with biases. A big one is loss aversion. Studies show losing money feels about twice as bad psychologically as gaining the same amount feels good. This is why people freak out and sell at the absolute worst time when the market's already down. They lock in those losses.
That fear response is powerful.
Yeah.
So how do you actually fight that bias when things look scary? Is there a practical trick?
Structure helps. One recommendation is to actually journal your investment decisions. When you buy something, write down why. I bought VOO today because my goal is long-term retirement, and my strategy is buy and hold diversification. I plan to hold for 20 plus years.
Mm-hmm.
Then, when the market is crashing and you feel that panic, pull out the journal. Read your own calm, rational reasoning from before. It can act as an anchor.
Okay, journaling as an emotional regulation tool. I like that. That directly tackles the big myth too, right? The idea that you can successfully time the market.
Oh, absolutely. It's probably the most damaging myth out there. It's a siren song. The data is brutal on this. If you missed just the 10 best days in the market over the last 20 years, your total returns would have been cut by more than half. Half. You have to stay invested through the noise. You also need to be wary of something called a value trap.
A value trap?
Yeah, a stock that looks cheap based on its PE ratio, but it stays cheap or gets cheaper forever because the underlying business is actually flawed or failing. It looks like value, but it's a trap. So just looking at PE isn't enough. You still need to understand the business.
Okay, lots to consider there. So we've got the steps, the strategies, the risks. Let's put it all together. Building that unbreakable portfolio. What's the basic structure look like?
Keep it simple, especially at first. A common starting point is allocating maybe 60% to 80% of your portfolio to stocks, mostly broad market index funds. And the rest, that 20% to 40%, goes into bonds or cash equivalents. Bonds act like a shock absorber when stocks fall. That's your basic risk management.
And diversification is key within that stock portion.
Absolutely critical. You need diversification across different sectors of the economy. Don't put everything in tech, for example. We saw what happened in 2022 when tech stocks got hammered. Maybe keep any single sector, like tech, to around 20-30% max. Spread the bets.
Makes sense. And not just sectors.
Right. Also, geographical diversification. Don't have all your investments tied just to the U.S. economy. Things can happen here that don't affect other parts of the world as much. Putting maybe 30-40% of your stock allocation into international markets is a good rule of thumb. An easy way is using a total international stock ETF, like VXUS we mentioned. It covers thousands of companies outside the U.S.
Okay, build it diversified. Then what? You don't just set it and forget it entirely, do you? What about maintenance?
Good point. You need some upkeep. The main task is rebalancing, usually once a year. Over time, some investments will grow faster than others. Your tech stocks might surge, making your stock allocation drift higher than your target, say from 70% to 80%. Rebalancing just means selling a bit of the winners, locking in some profit, and buying more of the assets that lagged, bringing your portfolio back to its target percentages. It forces discipline. Buy low, sell high, essentially.
Keeps your risk level where you want it.
Exactly. And that brings up that X-Fire tip from the research. Reinvest your dividends. When your stocks or funds pay out dividends, don't just take the cash. Set your brokerage account to automatically reinvest those dividends back into buying more shares of the same investment. It seems small, but over decades, that compounding effect is incredibly powerful. It's like a silent engine boosting your returns.
The silent billionaire maker, they called it. Okay, let's look ahead now, 2025 and beyond. What are the key trends or themes investors should be watching?
Well, the current state, as we record this, the S&P 500 has had a strong run, up maybe 15% year to date, largely fueled by that AI excitement. But there are definitely clouds on the horizon to watch. When will the Federal Reserve actually cut interest rates? What's happening with global conflicts, trade tensions? These add uncertainty, potential volatility.
So caution is warranted. What about the big future themes?
The AI and energy link seems huge. Building out AI data centers, training models requires staggering amounts of electricity. This puts a spotlight on, well, the companies that generate and transmit that power, utilities, energy infrastructure. They become almost like a picks and shovels play on the AI gold rush. Maybe less glamorous than chip makers, but essential.
Interesting. What else?
The sustainable shift continues to gain momentum. ESG investing, focusing on environmental, social, and governance factors, isn't just niche anymore. Projections show ESG-focused funds could double in assets by 2030. It reflects a real change in how capital is being allocated, especially by younger generations.
So investing aligned with values is becoming mainstream.
Pretty much. And another big one, maybe less discussed, but very real. The ongoing housing shortage in many areas. This creates potential opportunities in REITs, real estate investment trusts. They let you invest in large-scale real estate apartment buildings, warehouses, malls, and collect income without being a direct landlord.
Okay, AI power, sustainability, real estate, anything really far out.
On the deep horizon. Keep an eye on quantum computing. It sounds like sci-fi now, maybe. But the sources suggest that by, say, 2035, quantum breakthroughs could fundamentally change things like financial modeling, risk analysis, even how trading algorithms work. It's not something you invest in today necessarily, but starting to track progress in that field seems like a smart, long-term strategic awareness move.
Fascinating stuff. Okay, we've covered a lot of ground. The what, the how, the strategies, the future. What's the final takeaway for someone listening?
I think it's that this isn't a one-time task, right? Mastery or even just competence, it's a lifelong journey. It requires ongoing learning. The world changes, markets change. Carve out maybe 30 minutes a week, read articles, watch videos. Investopedia's YouTube channel is great. Read foundational books like The Intelligent Investor. Maybe dip into online communities like Reddit's investing forums for beginners. Stay curious.
Continuous learning. Got it. And for me, the big picture takeaway is reframing it. You're not just playing the market. You're methodically, patiently authoring your own financial future. There's a quiet satisfaction, isn't there, in watching that small, consistent effort compound over years, decades, watching $100 a month slowly build into something significant.
That's exactly it. The quiet thrill of compounding.
So let's leave our listeners with a final thought to wrestle with. History teaches us resilience. The market crash of 1929 saw an 89% drop. In 2020, we saw a 34% drop in just 1 month. But the unwavering lesson from every single crash is this: markets recover. And historically, they recover to reach new highs. So knowing that inevitable long-term resilience is baked into the system, what specific concrete action are you taking today, like right after this deep dive, to start positioning yourself to benefit from it? Don't just think about it. Start building.